Welcome to the Deep Dive. Today, we're taking a closer look at Edward Jones. We've got this investigative source, and we're really going to dig into their structure, fees, and, well, their regulatory history.
Yeah, our goal here is to sort of figure out the trade-off because, I mean, their presence is massive, right? We're talking 15,000 offices, almost $2 trillion managed.
More branches than Starbucks, apparently.
Exactly. It's everywhere. But, does that convenience, that local advisor you can shake hands with, does it come with a hidden cost for the average person saving for retirement? That's what we need to understand.
Okay, so let's jump right into probably the core issue here. The source really hammers this point.
Yeah.
You're Edward Jones' advisor.
Mm-hmm.
Legally, they're a broker-dealer.
Mm-hmm.
They're not held to a fiduciary standard. That's crucial.
It really is the central conflict. Think about it like this. A fiduciary is supposed to act totally in your best interests, like a doctor recommending the absolute best treatment, even if they don't make money from it.
Right, the optimal choice.
The optimal choice. But a broker-dealer, they just need to recommend something suitable. Now, suitable means it's basically okay, not totally wrong for you.
But not necessarily the best or the cheapest.
Not necessarily. And the firm itself admits, in disclosures that they profit when advisors guide clients towards certain products, often more expensive ones. So there's this built-in conflict right there.
Okay, so that difference, suitable, not optimal, leads us straight to the money. The fees, their main advisory solutions program, it starts at 1.35% a year.
And hold on, that 1.35%, that's just the start. That doesn't even count the fees inside the funds they put you in or platform fees.
So let's put that in perspective. If you have, say, $500,000 saved up.
A common retirement goal for many. Over 20 years, those fees, just the main ones, could add up to nearly $90,000 gone.
Wow. $90,000. How does that compare?
Well, you look at a low-cost competitor like Vanguard, maybe offering a similar service. Their fee might be around 0.3%. So Edward Jones is roughly 4 times higher.
4 times. So why? Why so high? The source connects it back to how the advisors get paid, doesn't it?
It really does. It boils down to incentives. Advisors get a pretty big slice of the revenue, something like 36 to 40%, specifically from selling high-fee things. Think actively managed mutual funds, variable annuities.
The expensive stuff.
Exactly. The more expensive the product they sell you, the bigger their paycheck. So the system itself encourages selling pricey funds, maybe instead of suggesting, say, simpler, cheaper index funds that might actually perform just as well or better for the client long term.
Which feeds right back into that suitable versus optimal issue we started with.
Precisely. And maybe unsurprisingly, this seems to bleed into their run-ins with regulators. The source cataloged, I think, 76 different regulatory violations over time. That's quite a few.
Yeah, not just typos. And some are pretty significant, like that 2015 SEC case. Edward Jones paid out $20 million.
Right, that was about municipal bonds. Essentially, the SEC found they overcharged customers by about $4.6 million. They were marking up bonds they already owned and selling them to clients at inflated prices instead of passing on the better price.
So basically taking extra profit directly from clients on those bond sales.
Mm-hmm. And it doesn't stop there.
Clear.
More recently, 2025, wasn't it? About $17 million in state fines.
Yeah, that was tied to how they supervised moving clients into fee-based accounts.
Which, again, kind of highlights the core issue, right? The structure incentivized moving people into accounts that generated more ongoing fees for the firm, maybe without always ensuring it was truly the best move for every single client at that specific time. The source noted this pattern. Overcharge, fail supervision, settle without admitting wrongdoing, continue operations.
Okay, so wrapping this up, what's the big picture for someone listening, someone maybe thinking about EJ or already with them? The source's take is pretty clear. It's not presented as a scam operation.
No, not a scam, but it's described as, quote, commission sales wrapped in advisory language. Meaning, if you have really complex needs, like intricate estate planning, or if having that local office and face-to-face service is your absolute top priority, they do provide that.
But you pay for it a lot.
You pay a very significant premium for it. For just standard retirement investing, though accumulating wealth over time, the argument is those high fees are mostly paying for that huge branch network and advisor commissions.
And not necessarily leading to better investment results compared to lower-cost fiduciary options like, say, Vanguard, Fidelity, or Schwab.
Correct. So the final thought, the thing you really need to ask yourself is, if growing your money as much as possible is the main goal, what's that local handshake really worth? How much extra are you willing to pay year after year just for that convenience? That's the key question here.